Have you ever wondered what happens when nearly $2 trillion just vanishes from the financial system? It sounds like the plot of a Hollywood blockbuster, but this is happening right now, quietly behind the scenes of the U.S. economy. Since early 2023, a staggering $1.9 trillion has been pulled out of the U.S. banking system. This isn't just a small shift. It's one of the largest and fastest outflows of money we've ever seen. But where's all this money going? And more importantly, why? Is this a sign of a looming crisis, or is it something else entirely? Today, we're going to unravel this massive financial mystery piece by piece. We'll explore the forces driving this exodus, what it means for the banks, the economy, and for your own money. So stick around, because what we uncover might just change the way you think about the financial world. To really understand what's happening, we need to talk about a crucial player in this story, the Federal Reserve's Reverse Repo Facility, or RRP for short. Now, that might sound complicated, but think of it as a super safe short-term parking spot for cash, offered by the Fed itself. Money market funds, which are investment funds that deal in low-risk, short-term assets, love this facility. Why? Because it offers them a risk-free return on their cash. When you put money into a money market fund, they take that cash and look for a safe place to invest it to earn you a little interest. The RRP became their favorite spot. At its peak in December 2022, a mind-boggling $2.5 trillion was parked in the RRP. It was a mountain of idle cash, sitting outside the traditional banking system. So, what changed? Why did this mountain of cash start to shrink? The answer lies in the Fed's battle against inflation. To cool down the economy, the Fed started aggressively raising interest rates. This had a direct impact. But there was another equally important move they made: quantitative tightening, or QT. This is the opposite of quantitative easing, or QE, which you might have heard about after the 2008 financial crisis. With QE, the Fed printed money to buy bonds, pumping liquidity into the system. With QT, they're doing the reverse. They're letting the bonds they hold mature without reinvesting the proceeds, effectively pulling money out of the financial system. This process started slowly but has been ramping up. At the same time, the U.S. Treasury needed to borrow more money to fund government spending. So they started issuing a lot more Treasury bills, or T-bills. Now here's where it gets interesting. Suddenly, those money market funds had a new, very attractive option. Instead of parking their cash at the Fed's RRP for a certain interest rate, they could now buy these newly issued T-bills, which were offering a slightly higher return. For a fund managing billions of dollars, even a tiny difference in yield is a huge deal. It was a simple business decision. Why settle for a good return when you can get a great one, with basically the same level of safety? So they started a massive migration. They pulled their money out of the RRP and plowed it into T-bills. From its peak of $2.5 trillion, the cash in the RRP has now plummeted to around $400 billion. That's a $2.1 trillion shift, and a huge chunk of that $1.9 trillion we mentioned at the start. This massive movement of money acts like a buffer. Think of the RRP as a giant shock absorber for the financial system. The Fed is draining liquidity through quantitative tightening, but instead of this drain directly hitting the reserves of commercial banks, which could cause a credit crunch and panic, it's first draining this big pool of excess cash sitting at the RRP. The money is just moving from one government pocket, the Fed's RRP, to another, the Treasury's general account, by way of money market funds buying T-bills. This has allowed the Fed to continue its QT program without causing immediate widespread distress in the banking system. It's been a silent, behind-the-scenes maneuver that has kept the financial plumbing working smoothly, at least for now. But this brings us to the big question: what happens when the shock absorber is gone? The RRP balance is getting very low. Experts predict it could be completely empty within the next couple of months. Once that buffer is depleted, the Fed's quantitative tightening will start to have a much more direct impact. The liquidity drain will no longer be absorbed by the RRP. Instead, it will start pulling directly from commercial bank reserves. Bank reserves are the cash that banks hold at the Federal Reserve. They are the lifeblood of the banking system, ensuring banks can meet their daily obligations, lend to each other, and provide credit to businesses and consumers. When these reserves start to fall, things can get tricky. We saw a preview of this back in September 2019. The Fed was also doing QT, the RRP was low, and suddenly there was a cash crunch in the overnight lending markets. Interest rates for overnight loans between banks spiked dramatically because there just wasn't enough cash in the system. The Fed had to step in with emergency injections of liquidity to calm things down. The fear now is that we could be heading for a repeat of that scenario, but potentially on a larger scale. As bank reserves dwindle, the financial system becomes more fragile and more susceptible to shocks. Banks might become more hesitant to lend, tightening credit conditions for everyone. This is what analysts refer to as the system hitting a binding constraint. So what does this mean for the average person, for you and me? While these are high-level financial mechanics, the ripples can definitely reach your wallet. First, if QT starts to seriously strain bank reserves, it could lead to tighter lending standards. Getting a mortgage, a car loan, or a business loan could become more difficult and more expensive. Banks will be more cautious about lending out their dwindling reserves. Second, it creates a more volatile market environment. When the financial plumbing is under stress, markets for stocks and other assets can become more unpredictable. We could see bigger swings and more uncertainty, which is never comfortable for investors. And third, there's the impact on the broader economy. If credit tightens significantly, it can slow down economic activity. Businesses might pull back on investment and hiring, which could, in the worst-case scenario, increase the risk of a recession. It's a delicate balancing act for the Fed. They want to control inflation without breaking the financial system in the process. Now, it's not all doom and gloom. The Federal Reserve is well aware of this dynamic. They are monitoring bank reserves and money market conditions very, very closely. They have the tools to respond if things get out of hand. For instance, they could slow down the pace of quantitative tightening, or even stop it altogether to prevent a severe liquidity crunch. They've already announced they will start tapering the pace of QT beginning in June. This is a clear signal they're trying to ease the pressure and land the plane softly, rather than risk a crash. They can also provide liquidity through other facilities if needed. The goal is to drain the excess liquidity created during the pandemic without repeating the mistakes of 2019. They want to find that just right level of bank reserves, not too much, not too little. So where do we go from here? The next few months are going to be critical. All eyes will be on two key numbers: the remaining balance in the reverse repo facility and the level of commercial bank reserves. As the RRP approaches zero, the real test begins. Will the Fed successfully navigate this transition, slowing QT at just the right moment to keep the system stable? Or will they miscalculate, triggering another liquidity squeeze and market turmoil? It's a multi-trillion-dollar tightrope walk. For us, it's a powerful reminder that the financial system is a complex, interconnected machine. The silent movement of trillions of dollars in one corner can have loud, far-reaching consequences in another. It underscores the importance of staying informed and understanding the forces that shape our economic reality. This isn't just an abstract financial story. It's about the stability of the system that underpins our jobs, our savings, and our investments. To sum it all up, the silent exit of nearly $2 trillion from the U.S. financial system isn't a simple case of capital flight. It's a complex reshuffling of liquidity, driven by the Federal Reserve's fight against inflation and the Treasury's borrowing needs. The reverse repo facility has acted as a crucial temporary buffer, absorbing the initial impact of quantitative tightening. But that buffer is now almost gone. As we enter the next phase, where QT directly impacts bank reserves, the risks and uncertainties are set to rise. The Fed is trying to engineer a soft landing, but the margin for error is slim. This is one of the most important financial stories unfolding right now, and its outcome will have a significant impact on the economy and markets for the foreseeable future. We'll be keeping a close eye on it. Thanks for watching, and if you found this breakdown helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next deep dive. See you in the next video.